Intel recently announced earnings for their second quarter of 2023. Their stock is down about 1%, while the rest of the market is up 8% over the last year. So they are underperforming the market. But in this video, I'm going to look at some of the recent news that came out surrounding Intel. I'm going to look at their financial statements and then use a discounted cash flow model along with figuring out Intel's weighted average cost of capital to figure out the estimated intrinsic value per share for Intel. So right here, we can see from this article, it's titled, "Where Will Intel Stock Be in 1 Year?" Some key points I touch on include the fact that Intel's second quarter numbers easily beat Wall Street's expectations. Their revenues, margins, and profits are rising sequentially again, and also they expect to generate stronger growth in the second half of the year. Right here, they point out that revenue declined 15% year over year to $12.9 billion, but it still exceeded analysts' expectations by $760 million. At the moment, their sales and profits are shrinking, but they could be in the middle of a cyclical turnaround, which could end up benefiting their business. Right here, they point out the different operating segments of their business and how they performed for the second quarter. Their client computing group in the second quarter generated 53% of their revenue. This core part of their business mainly produces their x86 central processing units for their PCs or for PCs, but those sales shriveled over the last 8 consecutive quarters as the spike from the pandemic cooled off in the post-pandemic world. Also, their second biggest operating segment, which is their data center and artificial intelligence group, ended up making up 31% of their revenue. This part of their business builds CPUs and programmable chips that are high-end for data centers, but this segment's revenue also declined year over year for 5 consecutive quarters due to macroeconomic headwinds as a result of the overall shift in the economy, which forced a lot of large organizations to rein in their spending on big data center upgrades. We can see from this table right here, they point out, or they give a visualization of the year-over-year earnings, or not earnings, but revenue growth for Intel. From the second quarter of 2022 all the way to the second quarter of 2023, their revenue growth has declined year over year by 17%, 15%, 28%, 36%, and then 15% again in the most recent quarter. So really not very good news for Intel historically. But they do point out right here that on a quarter-over-quarter basis, Intel's revenue for their different segments grew 17%, 8%, and 7% from the last quarter, which was the first quarter of 2023. And in total, their revenue grew 10%. They expect that in the third quarter of 2023, their revenue will increase to $12.9 billion or around $13.9 billion, which would represent 8% growth from the second quarter, but it would still be a 9 to 16% decline year over year. So to end off the article, where will Intel stock be in a year? Analysts are basically expecting that revenue and earnings per share are going to decline 27% and 81% for the full year, but for 2024, they expect revenue and earnings to rise 13% and 346% as the cyclical downturn finally ends. Intel stock at the moment, as a result of that, could be reasonably valued, but not cheap. They're currently trading at around 23 times next year's earnings, and the dividend cut they recently implemented ended up reducing their forward dividend yield by 1.5%, making them less appealing to income investors. So they're headed in the right direction, but a lot of this recovery could already be baked into their year-to-date 35% stock market rally. So interesting to see where Intel goes from here. If they're able to continue the momentum and increase their earnings and eventually end up turning a profit again and increasing their revenue and their growth year over year, then it could end up meaning a pretty substantial rebound for Intel, which could provide a lot of value back to shareholders. Right here, we can see their financial statements. For their revenue decreased from $15.3 billion to $12.9 billion year over year. That's a decline of 15% year over year. But their net income increased from a net loss of $454 million to net income of $1.4 billion. So that's an increase of 400% in their bottom line net income year over year. And that came mainly, as you can see, from a benefit from provision for income taxes amounting to about $2.2 billion. So it's safe to say that the increase in their earnings didn't necessarily come from growth in their business or better health in their business. It mainly just came from taking benefits from prior period tax losses. Then we can see right here on page 7, their balance sheet. Total assets are up from $182 billion to $185 billion. And then we can see they have $104 billion of stockholders' equity, and of that, about $67 billion of that is retained earnings, which declined from $70 billion of retained earnings in the prior period. Then lastly, for their cash flow statement, we can see that they're comparing the first half of 2022 to the first half of 2023. Operating cash flow declined from $6.7 billion to only $1 billion. And in their financing activities, which we can see right here, I believe, yep, they basically paid out dividends to stockholders of about $2 billion, which is down from $2.9 billion in the first half of last year. So they're still prioritizing returning value back to shareholders, actually a lot more so if you rank it as a percentage to their operating cash flow, since they're actually returning $2 billion when they only had $1 billion of operating cash flow. So it's definitely a good sign for shareholders who want to see Intel returning value back to shareholders. Right here, we can see this discounted cash flow model to figure out the intrinsic value per share for Intel. I'm using a negative growth rate here, unfortunately, of negative 9% for the next 5 years. And I got that from their historical cash flow growth rate. We can see that in 2018, they had free cash flow of $14.25 billion. But in 2021, their most recent full year where they had positive cash flows, they had free cash flow of $9.66 billion. So that's a decline over 4 years with a compounded annual growth rate of negative 9.26%. So that's where I got the growth rate that I'll be using for this analysis in this video. The weighted average cost of capital, which I'm going to be using to calculate the discount rate to discount their cash flows to the present value of their future cash flows, I got from this table right here, weighted average cost of capital calculation. We can see that from their balance sheet that they had about $103 billion of equity, $78 billion of liabilities. Cost of their debt, which is their interest rate on their total debt, came out to be on average about 1.18%. The tax rate in their most recent full year was negative because, as we saw, they were taking benefits from their taxes, so it's negative 3.2%. 10-year treasury yield at the moment is about 4%. Intel's beta is 0.88, so they're basically a little bit less volatile than the rest of the market. So based on that and the average stock market return of 10%, I calculated their cost of equity, which is basically just a risk-free return added to Intel's beta multiplied by the market return minus the risk-free return. That gave me 9.28% for their cost of equity. Their balance sheet is made up 56% of equity and 43% of debt. So to calculate their weighted average cost of capital, I multiplied the equity proportion by their cost of equity, added that to the debt proportion, multiplied by their cost of debt, and multiplied that by the tax yield, which is 1 minus the tax rate. That gave me the 5.79% weighted average cost of capital that I'm using to calculate the discount rate for this model. We can see terminal value 10, year one free cash flow, which was in 2021. I'm not using their 2022 free cash flow because it was negative, and you can't use a negative free cash flow metric in a model like this, or otherwise it won't work. So I'm using the most recent full year where they had positive cash flows, and that was 2 years ago with $9 billion. Currently, they have a net debt position of $30 billion and about 4 billion shares outstanding, putting their intrinsic value per share at around $12 per share, which means they're definitely not trading below intrinsic value per share. Right now, they're trading at $35 per share, which means that they're definitely trading above intrinsic value per share based on these current estimates. Obviously, I encourage everybody to do your own due diligence, though, when you're analyzing companies in the stock market. Right here, we can see from this competitor analysis, I'm comparing them to some of the other companies in their industry, particularly AMD and NVIDIA. We can see that for gross profit margin, they come in at 42%, which is right in between AMD and NVIDIA. Same with net profit margin, 12%, and return on assets, 4%. So they're middle of the pack in terms of profit margins. We saw that most recently they are not profitable, so they don't really have a price to earnings ratio, but they do pay the highest dividend yield out of the three companies at 5.52%. So basically they pay you $5.50 for every $100 you invest into Intel per year. So based on this, it looks like from a profit margin perspective, they're basically middle of the pack. They're pretty competitive compared to AMD and NVIDIA, but at the moment, those profit margins were for their most recent full year. In 2023, we saw they weren't profitable, so hopefully they'll be able to turn a profit again in the future in order to continue to grow their business and be even more competitive to AMD and NVIDIA. And to end off the video, I wanted to compare Intel to some of the other companies we've looked at in the past. We saw that from intrinsic value, their share price currently is not trading below intrinsic value, and it's not trading at a good enough price to get onto this table. Right now, Google, Albertsons, Alibaba, Etsy are the only companies that we've looked at that are trading below intrinsic value per share. We can see that for growth rate, Intel's growth rate was negative, definitely not good enough to get them onto the growth rate table. Kura Sushi holds the number one spot so far with a 37% growth rate. Gross profitability only came out to about 42% and 12% net profit. That means that right now they don't have a good enough gross profit margin or net profit margin to get onto either one of the profitability tables. We can see that for dividend yield, Intel comes in first place, pushing 3M out of the number one spot with a 5.52% dividend yield. And then for quarter two year-over-year revenue and earnings growth, for revenue growth, we saw that they were down 15%, so not good enough to get on that table. But for the second quarter, they did increase their earnings by 400% from a net loss. So that puts them in first place for all of the companies we've looked at so far for the second quarter for year-over-year earnings growth. Then lastly, for stock performance over the last 5 years, we can see that Intel is currently down 27% over the last 5 years, so not good enough to get them onto the table. Tesla holds the number one spot at 1,144% over the last 5 years. So based on this, it looks like Intel is pretty competitive for the second quarter year-over-year earnings growth and also for dividend yield. But for stock performance, profitability, revenue growth, growth rates, and share price to intrinsic value, as we saw from the discounted cash flow model, they are currently not that competitive and they're not trading below intrinsic value per share. In terms of comparing them to the other companies in their industry, it looks like Nvidia is pretty dominant. They have the highest profit margins, and AMD and Nvidia are trading at pretty high price to earnings ratios, whereas Intel, we can't even really tell what they're trading at relative to their earnings because they're currently not really turning a profit. So hopefully they'll be able to do that in the future. But based on this, it looks like it's kind of difficult to tell if they're competitive to AMD and Nvidia. You'd probably want to give it to Nvidia for the competitor analysis. So let me know in the comment section down below what you guys think of Intel. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.